Well, good morning, everyone. Welcome to this webinar. We're going to talk about corporate credit today with FlexPath Immigration Partners. I'm Marie Ekberg. I'm the editor-in-chief for EB-5Investors magazine. Welcome, everyone. I'm going to let you guys introduce yourself, starting with Jeff.
Hi, everyone. Thanks for joining this morning. So just a little bit about myself and about FlexPath. So I've been in EB5 for about 13 years. I've been in the C-suite of two of the largest, most established regional centers. During that time, raised more than $1.5 billion, helping 3,000 to 4,000 investors come to the U.S. John, my partner, he and I have been friends for almost 20 years. John's background, he'll introduce himself, but he's a corporate credit guy at a pretty prestigious level. In addition, as a side job, co-founded a company that's currently worth about $5 billion. But John was always fascinated with corporate credit, and always fascinated with EB5. And so we were talking especially over this last year or so, the last regional center I was with, the difficulty in finding quality real estate projects. In fact, the last regional center I was with, we probably went like 4 or 5 months without a new project. And so John said, why can't we use corporate credit, an existing business in EB5? And so that really was the impetus to launch FlexPath, which we did in February. So John, I'll let you talk a little bit more about your experience.
Sure. Thank you. So I'm Jeff's partner in the business. As he described, he's the EB5 guy, and I'm coming at it from a different angle. So I spent 25 years on Wall Street in corporate debt or corporate credit markets. You'll hear us using that interchangeably. And what that basically means is, we arranged financing for companies that needed to borrow money, right? And we dealt with large companies, we dealt with small companies, and structured all different types of deals. So really got a very good understanding of, corporate credit and all the nuances of those markets. As Jeff mentioned, I've also had an itch to be an entrepreneur. So started a few different companies, but the most notable for this conversation is World Insurance. So World Insurance was an insurance brokerage roll-up strategy. Over the years, we bought hundreds of other brokerage companies, and ultimately sold out to private equity initially in 2020, and then had another transaction since then. But the key is for all of those, to buy all those companies, we needed to go out and arrange financing ourselves, right? So it's sort of the Wall Street side showed me on the banking side, and then I became the borrower through my entrepreneurial. So bring both of that, both those sides of the table and that skill set to FlexPath. And as Jeff mentioned, that really had a lot to do with us launching this firm, right? So we see what we call corporate credit or existing businesses as a new asset class. It's an alternative to real estate. We have real estate projects as well. I mean, right now we have one real estate project that we're raising money for, in addition to the corporate credit deal that we're going to chat a little bit about today. So again, this is not meant to be, we're not only going to be corporate credit guys, right? We're going to be EB5 guys, and this is going to be an alternative. And one person that we should mention who's not on this call, who really is our resident, real estate expert, is a guy named Greg Forrester. He's our CIO, spent a bunch of time at GE Capital, running their hospitality group. And, at the time they were the biggest non-bank lender in the industry. And he's underwritten more deals, and larger size than probably the entire EB5 market, put together. So we have a lot of real estate expertise as well. So, but inherently, as we discuss corporate credit today, we'll be comparing it to real estate because that's what the EB5 market's used to. I don't know, Brandon or Phuong, when do you guys want to go next?
Yeah, thank you, John. That was a great overview. This is Brandon Meyer. I'm the founder and managing partner of Meyer Law Group, an immigration law firm based in San Francisco with additional offices in New York, Charlotte, North Carolina, Guangzhou, China, and Ho Chi Minh City, Vietnam. I've been involved in the EB5 space for nearly 30 years now, and looking forward to the rest of the conversation today.
Yeah, this is Phuong Lei. Like Brandon, I'm also an attorney. I am a partner with KLDP LLP. We are basically, although we're an immigration firm, I like to say that we're really an EB5 specialist firm. It's 99% of what we do. We have done a substantial amount of project structuring, advising businesses and everything else, setting up regional centers. So this webinar, this topic, when Jeff and John brought it to us, I was like, oh, this would be fun. So I'm looking forward to it as well.
All right, thank you, everyone. So this webinar, we're going to tackle the corporate credit and compare it to real estate. We're also going to talk about your new project, the K9 Resorts, and then we'll kind of in the end there, we'll talk about the new changes in the industry, the new regulatory changes, and then we'll open it up for Q&A. So if you guys have some questions when we're talking here, you guys can type that in, and we'll try to answer as many as we can. So with that, let's talk about the corporate credit. Seems kind of like a new idea, but what are some of the challenges that, from an immigration standpoint?
Yeah. So Marie, it seems like a new idea. I think it's been around for a little while, but I think our approach to it is a little bit different. And so Phuong, you've structured a ton of deals. So have you seen similar type structures to this in the past?
You mean in terms of corporate credit or in terms of
Yeah, in terms of an existing business expansion.
Yeah, so basically, I think the key that you put on the key term there is expansion of existing business, right? A lot of EB5 deals, a lot of EB5 projects we have out there are, I mean, 99% of the business is real estate development. But there are existing franchises or business models and everything where I think for those people, you're not trying to build out another hotel or another multifamily office building. What you're trying to do is use EB5 to expand the footprint of your business, right? We've seen this with, for example, like charter school operators who operate a number of different charter schools in different areas. We see it with franchisors who have restaurant concepts or school concepts. And now, after like 15, 20, 30 of them, they can use EB5 because they have a pipeline of locations they want to open up. EB5 is perfect for that. So this concept of you guys using EB5 uh, interlaid with your own money and everything else, where you have these 4 or 5 whatever locations coming up, is a perfect candidate for EB5.
Right.
Yeah,
Right. I mean, yeah, sorry, Brendan.
yeah. In some ways, this is almost a distinction without a difference. So, like, if some name brand hotel operator is consenting to having a new hotel constructed in, say, Elko, Nevada, where I am today, using EB5, yes, it's set up in a way that the hotel is a new business, new standalone business on its own, but the name on the outside of the hotel is hardly new. And so so it's really so it's like, yeah, you're expanding an existing business, but each one of these businesses in EB5 is set up as an independent entity for the most part, maybe within the fund structure that you have. And so it's really not that much different than what 99% of what EB5 is out there. It's just that maybe, just you're bringing a different product relative to everyone else, even though fundamentally it's the same structure.
What about from an investment standpoint?
Yeah, so just to key on what Brandon just say, you're exactly right. So it is the same structure from an immigration standpoint, right? But it's not the same structure from an investment standpoint. So Jeff, do you mind bringing up the
Sure.
deal structure slide real quick?
Yep. Okay.
So as you can see from this slide, right? So on the left-hand side, you'll see your typical real estate deal. And this is not, this is not EB5. This is just the way real estate works, right? So for decades, right? Some really smart lawyers got in a room way back when and said, hey, why don't we set up a new entity for each project and make that entity bankruptcy remote from the developer, from the sponsor, right? So if you look at that little diagram, and this is the way, almost every deal works, there's a new entity that creates the new project. You invest in that project, and then your, investment is also directly into that project, right? There's no support from the developer. You can have a billion-dollar developer. That's great because it's always good to have a well-capitalized developer, but they don't necessarily have the obligation to come in and save that individual project if the project gets in trouble, right? So real estate by design, as an industry, is bankruptcy remote, and the repayment is mostly relying on that one individual project, right? So it takes 2 to 3 years to build, a couple of years to stabilize, and then most of these deals, just try to get refied at whatever it is, 5 years out. If you look on the right-hand side, what we consider corporate credit, right, with an existing business, right here, you're investing in the company as a whole. that already has existing operations and is looking to expand, right? So these new locations that we talk about, that's where the spending is, and that's where the jobs are created from, and so from an immigration standpoint. But ultimately, the key to this whole thing is you're able to separate the immigration from the financial investment, right? So your immigration and your job creation comes from those four new locations, but the financial investment is backed by the entire company, right? And all the assets that it currently has. So again, this isn't our invention. I'd love to say we created this. This is just the way corporate credit works, right? They're used to doing enterprise level financing that's backed by the entire borrower, right? So what's different, you don't get a lien on an individual building or an individual, resort or project. You get what's called contractual priority in the entire business, right? So you sit in that capital structure of the entire corporate business, and that entire business supports the repayment of your investment. So,
And Phuong and Brandon, when we were looking at this and talking about this structure, and John was questioning, will this work for EB5? And I said, and you guys know this, your experience, right? I've seen plenty of real estate deals where the collateral wasn't necessarily the only collateral wasn't actually necessarily just the project that was being built, right?
Mm-hmm.
Yeah.
Yeah, that's correct. And yeah, I think this is important as well because you'll see in a lot of typical EB5 deals, the offerer, the developer, the regional center will put out there, this is an XYZ branded project, and sure it is, but to your point, John, if that project runs into problems, XYZ Corporation is not on the hook for to repay the investors. And so then you'll see also a lot of these typical projects they'll give the new commercial enterprise, which for definitional purposes is where investor money goes into before it goes into the project. So and the investor actually owns equity in that new commercial enterprise or NCE. The developer will provide a completion guarantee or a repayment guarantee, not to the investors, but to that NCE, which fundamentally is nothing more than a piece of paper. And so it's difficult. And then, well, who do you actually enforce, the rights in the event of a project failure? You have to have that piece of someone on behalf of that NCE piece of paper, and then who do they actually go to? That's where a lot of these EB5 deals get a little vague, where they sound kind of great on paper, but when you start scratching through it, there's just nothing there or something goes wrong.
Yeah, I agree with Brandon. It gets a little flimsy, right? Because when you strip it away, what's there really to protect you and everything else? Especially in your normal EB5 deal where it's mezz and you're sitting behind like the senior and everything else where you may not have much collateral. So typically in EB5, I think most investors are used to being junior on whatever the land or the property, the assets is. Um, in this type of structure, though, it has come up, it just doesn't come up a lot because by and large, sometimes they don't even need EB5 money, or there's just not as many institutional players. Um, it is common, for example, for the investors in a particular project to have collateral over something else, right? Where sometimes what you see is a hotel might be built, but the investors actually have collateral on an adjacent piece of land. So here, though, I believe what's a little bit different about this and unique is that the collateral, I believe, so when you have this sort of thing where you have a privately owned parent company who still owns all locations, yes, you have the business and everything else, but you also have the professional management, their knowledge, their operations, their supply chain, and everything else. So I believe here the collateral is what the 20 other locations that are up and running that have been successful. And that's unique because you have cash flowing businesses, right? Whereas in other situations, even though you might have a senior lien, you still got to go out there, you got to go sell it, you got to go refi or whatever else, and it takes time, right? And it might depress its value. So anytime you have actual cash flowing businesses that are generating revenue, I think that's a huge plus. So yeah.
Mm. And Jeff, just to confirm, USCIS has reviewed the structure and issued a 956F approval. Is that correct?
That's correct. And in under 4 months, and we had some
Hmm.
brilliant immigration counsel
You're
working
not
on
illegal. Congratulations.
it.
Mm.
Yeah, I mean, look, I think because you guys like the familiarity with the structure is why we got the approval so fast, right? We purposely, John and I, didn't want to launch K9 until we had the approval because we thought everyone's going to look at it and say, oh, this is a weird structure. How's it going to get approved? So we delayed. We probably could have, we really just launched in the last couple of weeks. We probably could have launched a lot sooner, but we wanted that approval. You guys know as attorneys that the approvals are not that difficult to get, right? I don't want to brag and say, oh, we have an approved project. We'll be honest about it, right? It's a great marketing pitch, but I've been doing this a long time. You guys have been doing this a long time. If Brandon or Phuong signs off on my project, I know I'm going to get an approval, right?
Yeah, and the thing is, it's I think the fact that it got approved relatively quickly says something too. That part is random sometimes, yes, but the thing is, um,
With no RFE, right?
with
No
no RFE,
RFP. Nope.
no RFE. So the thing is, that means that USC didn't have many questions about it. So I think the other thing is, for a lot of investors out there, when they choose a project, right, for the most part, it's they invest into the NCE, and the NCE goes ahead and makes a loan or investment really into another one asset, one building, one hotel, one development, whatever else. Here, though, you have four different locations. So the concept of having a portfolio fund or basically investing into a portfolio of different projects, whether it's K9 locations or up like a pool of multifamily uh, apartment buildings that will be, that will come up in the next year or so. Though USS is used to that, so there are benefits to that, right? You spread out the EB5 money, your investment to the four different locations. I think part of the hope is like you're diversifying. You're basically diversifying risk by having these four different locations, and you pull together job creation, you share it. So there are benefits to it.
For
Yeah, I mean,
sure.
those are the two questions we probably get the most is about, hey, is it okay that you're doing four locations as part of the immigration investment instead of one? And then separately, hey, how do you get the entire organization to stand behind the investment as opposed to getting a lien on the individual four locations? So we spent a lot of time talking about that because it is different at EB5. But that's one of the concepts we want to hopefully clear up as part of this webinar.
Okay. Um, yeah,
Great.
nothing else on this, I don't think.
Yeah. So let's talk about how this looks like in practice. Let's talk about your new project, the Canine Resorts.
Yeah. So, anecdotally, I remember when I first told Phuong about it, he said, I can't wait to see how you're going to market this. And I said, thanks, bud.
I think I actually made fun of you, right? So
So, look, Canine Resorts, and I've done traditionally, 22 projects in EB5, most of them real estate, some infrastructure, but this was the biggest hold up for us doing it is people are going to say, wait, it's Canine Resorts, it's a dog hotel. Let's just talk about that first. So Canine Resorts is like the largest franchise of dog boarding and daycare in the US. So the entire system, the franchisor is about 60 resorts. Our partner in this is a company called LPHI, Luxury Pet Hotel Investments. They're the largest franchisee of Canine Resorts. So they currently own 18, and they're going to have 30 to 40 in the next year and a half. They're extremely well capitalized, and they have an aggressive growth strategy. What we are doing is we are financing 4 new locations in our first offering. We'll likely have another offering as well, but these things have to be pooled in the same regional center. And we only do projects that are groundbreaking or starting, right? So finding the real art is finding locations inside targeted employment areas next to each other that are beginning construction that we can finance. So the first 4, we're financing 4 locations, 2 in the Detroit suburbs, 2 in the Chicago suburbs, all in one regional center. These locations, all the K9 locations, are in wealthy areas and densely populated areas, right? That's what works for this. So by nature, it's a high unemployment project. It cannot be rural. You wouldn't want to invest in a dog hotel in a rural area. Doesn't
a
make any
getaway
sense.
dog hotel.
Yeah, that's a new concept. I'm gonna have to run
Yeah,
that by
see,
the team.
you're missing out. You should have thought about this.
Destination.
There you go.
Actually, you do it. Yeah, you do it next to the ski resort, so you can bring your dog with you.
So these builds, we're financing 16 million across the 4 locations. They're $3 to $4 million each. What's interesting about it is these builds are one of the drawbacks I thought about, when we first started talking about this project was that how do you get enough expenses for job creation? The great thing about this is they all have hospital grade sanitation and airflow. So it's a ton of spending in that stuff. So each location costs $3 to $4 million, creates a ton of jobs. The beauty of this, though, is construction-wise. They get constructed in 6 to 8 months and begin cash flowing. Not only that, it's a franchise. They're redoing the same thing over and over. They don't have to, it's not being creative. It's the same contractors, same suppliers, et cetera. Something you can replicate over and over. Unheard of, right? When we see construction failures in EB5 and real estate, and not just EB5, but all of real estate and issues and over budget, it's because construction might be different in certain places or present certain challenges. There are no unexpected challenges here, right? You're outfitting the same thing over and over again.
Yeah.
It's funny just on that real quick. So Jeff and I talk to these guys probably every other day at a minimum, and we were just getting an update on where everything stands. And the first location I think they started in whatever it was. I think, they really started in earnest in probably March or April. Although from a job creation standpoint, you're probably, there was some stuff going on before that. But anyway, they're going to the grand opening September 15th. So these guys are like, on time, on budget, which is pretty amazing, actually. But one of the things I wanted to just, circle back to, and Brandon and Phuong, I want to ask you guys, I don't know if you guys have any thoughts, because one of the things we do struggle with when we talk to investors is when you look at all the US CIS documentation, right? Like Brandon, when we develop the business plan, and what 90% of the PPM talks about the project, right? So they're always talking about the 4 locations. The business plan doesn't even reference the investment, right? And then we try to explain to people why this, from an investment standpoint, is great, and talk about the overall organization. And inevitably, people get a little confused by that. And I'm not sure, what we can do, if anything, but I don't know if you guys have any thoughts on that, because we do, until we get to have a detailed conversation with somebody, it just sometimes takes a little while to click.
Yeah, Phuong, you want to go first? Since I don't want to, I don't want to go with the first thought that I was about to lead with. So.
I want to hear your first thought. It's more fun. So part of it is, I think the concept is there's 2 parts really, right? And I get the investor confusion. Number one is the analogy I almost give is that it's like any other like brand name or business. So this to me is almost like at this stage a privately owned franchise business, right? Like Jeff said, plug and play. So the benefit of if you are, it's the same reason why people find franchises or well-run franchise concepts in general attractive. The concept should be that you have established a proven business model that works, right? You have, if you are having these, whether it's like these luxury dog hotels, right, which are nicer apparently than what most of us stay at, or whether it's like a fast casual hot chicken place, you generally speaking will like be. I think that if I have this much square footage space with this many employees, so here's my cost of goods and everything else, and I can replicate this over and over and over again. It's all very predictable, right? I know it takes to run it and operate and everything else. That's how you can take something and then go to basically build out and be up and running in 6 to 8 months. This, I think part of it is that's what makes this different than say, every other day there's another Four Seasons or there's a Waldorf or some other luxury hotel brand going up. But the thing is, those are not identical, right? They share the same name, the same title, but each of them are owned by different hotel groups in very different areas. So I think we've all seen like something can be called like a Ritz, but not all Ritzes are equally the same, right? So the cost of each location, the people who run and operate it can vary dramatically. So I think here the EB5 offering a raise or build out is for your next 4 locations. But in a way, it's also backed by the experience and expertise and of the actual parent company itself, which has done this in 20 other locations. So there
Yeah.
should be economies of scale, right? And efficiency and everything else and support that comes in here. So in
Yeah.
this kind of situation, I don't want to be the first one, right? But if I'm the 20 something one, then that makes more sense to me.
Yeah,
Yeah.
there's a more centralized strategy and thought that goes into the overall expansion as opposed to, so I think that portends greater long-term success.
Yeah. So actually, let's get into it a little bit, because listen, the best part about Canine Resorts is everything we're going to talk about right now, which is like, Jeff, pull up the capital stack slide just the strength of the business, strength of the management team, strength of the industry. Those are all the things that, now that you have a little bit of overview of the structure itself, it's really,
See my screen okay?
Yeah, can everyone
yeah,
see
yeah, I
the
can see it right
screen?
here. So anyway, this is again, and not to, again, I don't want to paint real estate in the wrong light. I mean, again, we're going to have real estate projects, but inevitably we have to compare this to real estate because that's what everybody's used to. So on this slide here, you see there's your typical real estate project, right? So your typical real estate project, is whatever, 70 to 80% debt, right? Including the EB5. And let's call it 20 to 30% equity, right? When you look at this K9 Resorts, which is the LPHI entity that we're, doing business with, they've raised 74.2 million of equity to date, right? EB5 post-funding will be 16 million after the first offering, and they currently only have 10.6 million of senior debt on the balance sheet, right? So we refer to it as an inverted capital stack, right? There's just, I mean, the amount of equity supporting this business is definitely outsized. And there's a reason for that because these guys, these are, we'll talk about the management team a little bit, but they're really smart people that didn't land on this project by accident, right? And they wanted to make sure that they wanted to expand this thing quickly and set themselves up for an exit in 2030, right? And the way they do that is having as much equity as possible. To do that, they teamed up with UOB as a sponsor who went out and was responsible for a number of things administratively, but most importantly, they're the ones out raising the money. And the capital raised on the equity is going to go until December 15th of this year. So they have 74.2 million now. They've already told us they've circled another 5 or 6. And who knows if they get to 100? That's where they're capping it at. But it's certainly going to grow a little bit from here. So the question that pops out is in this capital structure, why is there such little senior debt? And this is really the reason of how we're able to slide into this transaction, right? Because as I mentioned, these guys want to move quickly. And in corporate credit world, unlike real estate, right? They look to earnings, right? So this was a new business, a year and 9 months ago when they started. And they basically used that equity to go out and buy a bunch of mature resorts. So there's always inevitably in a franchise system, there's people who need to sell, right? There was a situation, somebody died, right? Somebody's getting divorced. Somebody's old and their kids don't want to take over the business. So inevitably there's someone selling, and the franchisor, just given the relationship they have with our team, every time there's somebody for sale, they come to our guys, right? So they were able to buy up a bunch of mature resorts as well as initiating and building some from scratch, right? So they were able to, while they did that, they go out and they try to get financing. And in order to get financing, they're getting slowed down by these, little local banks, right? Because ultimately, they're not going to get enterprise level financing until they get to a certain scale and size, which is about 10 million of earnings. So they were able to put, across 4 different loans, 10.6 million of debt. And that's where the frustration set in. And that's when, we initiated the conversation with them and said, we could be the capital for your expansion, right? So that's why we're slotting in. And it's funny, every location they look at this point, they check with us. Like we get emails and phone calls like, hey, does this qualify? And, we tell them like, there's that website, right? Where you can just type in the address yourself. You don't need to call us every time. But inevitably they're checking with us every time because, as Jeff mentioned, hopefully there's going to be, additional offerings following up on this one.
So,
But this
so
is, go ahead.
sorry, John. Sorry. So I want to zero in on the sponsor equity. Would it be, one of the things that Phuong and I tend to see, and Jeff, in the past you've seen, is you'll see kind of like in the developer capital stack, there'll be some equity figure mentioned. And when you kind of start scratching the surface, in more, not all the time, of course, but many times it tends to be what's constituting sponsor equity is, shall we say, highly favorable land valuation and or well, once the project is up and finished and up and running, operational, the land will be worth, 5x then. So let's give ourselves credit for a 5x equity contribution today, so basically, yeah, basically saying, same thing as like, let's give ourselves credit for having a fully funded 401k 30 years from now today.
I'm
And
good for it, right?
so,
I'm good for it.
yeah.
That's what they're basically saying. So,
And so would you say, John, that this sponsor equity is actually real cash as opposed to like
When it goes
Yeah,
potential
right.
public
inflation.
5 years from now, that's
Yeah.
No,
the
no, it's
outcome.
100% real cash. And these guys have, like I said, they've been in business since the beginning of 2025, right?
Mhm.
So, for example, at the end of last year, right, or actually it was recently done, it was finished in April, but they get audited every year by Cohn Resnick. So the audit as of 12/31, 25, right, they did a valuation on the equity and it already had, it had a growth rate of 18%, right? But this is the cash put into the business. So to your point, if we took the value of the business and counted that as equity, it would be a higher number.
Yeah, very important.
And then just to finish the thought on this slide, on the right-hand side of the slide, right, you also say, well, what is Canine Resort? So like Phuong mentioned, there's currently 18 resorts open today, right? And they're all cash flowing, right? Again, anytime you open up any new resort, it loses money the first year. That just happens right there as they're sort of ramping up their revenues. But because they purchased some mature resorts, like I said, they started in 2025, 2026, they've actually turned EBITDA positive already, right? So this is a business that's already making money given the existing locations, and then they're just going to continue to ramp up their revenues. We're doing the next four, and then every future resort that gets built, and some of those will continue to get built by equity because some of those don't qualify for EB-5. They already have signed leases for. Those will also become part of the pool of collateral that helps support your investment, right? And the other thing they did is they made some significant investments in the franchisor, the brand itself. And again, that's just another asset sitting on the balance sheet of LPHI that's there to support the investment.
So again, would it be safe to say, John, that the corporate and the backers of this really have some significant skin in the game if this doesn't go right?
Yes, absolutely. And there's a story to be told there that I think, Jeff's going to probably get to right now, right, Jeff? We're going to talk about the industry a little bit and who the management team and who's behind this, which is, again, as excited as we get about the capital stack and the balance sheet, it gets more exciting to us when you start talking about, in particular, the management team.
Yeah. I mean, from the dog industry itself, right? The pet industry, I shouldn't say the dog industry. There are other kinds of pets, although I don't know why you'd want to own one. The pet industry, um, so
Wow,
it
just
is
throwing shots out there for no reason, huh?
I know, right?
Don't hate on the cat lovers.
All the cat lovers just shut off the webinar. Um, so the pet industry, by its nature, is consumer non-cyclical. Non-cyclical means it doesn't have ups and downs, right? It's pretty static. It's closer to healthcare than it is to real estate. What's specific about the pet industry, which is amazing, and I didn't know this till we started doing due diligence, is it's at 30 consecutive years of growth with it, which is ridiculous. So even during COVID, it grew, which seems unlikely. Actually, COVID sparked growth, right? Because it sparked pet ownership. And I think there's plenty of pet owners who didn't know what they were in for when they got a pet during COVID and then went back to work. But that's another story. But that's driving demand as well. It's a huge market, but the luxury boarding is the fastest growing part of that market within pet industry, right? So you've got this system where you've got a non-cyclical business that is really I wouldn't want to say recession proof, recession resistant. And then you've got a high growth area inside that. So for that reason, we absolutely love it. The other piece is, and this is very unusual, is the sponsorship. John had mentioned UOB Global Capital. So UOB Global Capital is the private equity subsidiary of UOB, which is the second or third largest bank in Singapore. They own 30% of the fund that owns LPI. So what they did is they went out and raised the capital. Senior members of UOB invested personally as well, and they administer the fund, right? So this is on their platform. So you have world-class sponsorship, really unusual. Most interesting piece of this, though, is the management team. And so the CEO, or now he may have he's still part of the management team. He may have moved down from CEO, is a guy called Alan Liebman. Alan Liebman was the CEO of the Atlantis in Dubai and the Bahamas and the One and Only Resorts for many, many years, right? So you have the CEO of one of the largest, most successful hospitality brands, right? High-end hospitality brands who came in to run this. And what he has done has been pretty extraordinary. He's brought a lot of the hospitality industry expertise and brought it into what was really a mom and pop industry, right? Dog boarding was small little house, run by families, etc. And brought things like dynamic pricing, flexible pricing, things like that to the industry. And he's done such a good job that now this group runs all the company stores for K9, the parent. So when you take a look at that, the team that's involved and the institutional backing, I think it puts it, an extremely rare company. I've not seen this type of sponsorship that often in EB5.
Oh,
So
All
sorry.
right. So what?
No, I
sorry.
was I was responding. I was just responding to a question we had. And by the way, we have some pretty good questions coming in, so keep them coming. We're definitely going to leave some space at the end to try to address some of these questions. Um, so maybe real quick, just we covered obviously the investment side, but at the end of the day, it's the immigration side that people care even more about, right? So as these guys mentioned, we have the F approval. From a job creation standpoint, it's a $16 million raise. That's 20 investors. We need 200 jobs. Baker Tilly analysis came out at 266 and a half jobs. So that's like 30% plus cushion. And then on the sustainment period, we did something which I think is pretty interesting and should be attractive for investors. Is we did two things. First of all, when Jeff and I started this business and we looked at other projects and what frustrated people and what went wrong, one of the things was like people do these deals and their money doesn't get deployed for a year or two, or sometimes longer, right? So we look for deals in general, and this is a perfect example of that, where the capital get deployed immediately, right? So in our investment contract with the company, any money and all money, which we hopefully will be all 16 million, raised by September 30th, they need to take by September 30th. So that starts everybody's sustainment clock. And the other thing we locked in is they are restricted from paying us back before September 30th, 2029, right? Obviously, that's 3 years. The sustainment period is only 2 years. So we built in some cushion there, especially since our investment agreement covers future raises as well. So if we're raising another one next year, it would be under the same time frame. But anyway, we think that's interesting because it locks in the sustainment period, right? So you don't have to worry about redeployment. Your money's locked in here. Um, and in light of what's going on, some of the stuff that came out from USCIS recently on sustainment period, we think that's you know, is a nice feature to have in a deal. But I don't know, like Phuong and Brandon, like from the sustainment period side, I mean, I don't know if you guys want to mention anything that came out recently. I know there was some there that seems to be a rule that continues to move around a little bit that I think they tried to clarify recently.
Yeah, it should be noted that these things we talk about that sustainment period, potential changes of bridge loans, and other issues. These are all current proposals that may or may not be enacted in something between 0 to 100% of their present form at some undefined point in the future. So as of today, it doesn't really, our current understanding is basically 2 years when the jobs have been created, whichever occurs last, subject to terms and conditions of the loan agreement and the overall ability of the project to return capital to its investors. So I think coming in with that 3 year is definitely within the realm of reason and given the current sustainment environment. Now, I do think that some of the proposed changes, if they are enacted, are important. I mean, Jeff had mentioned that, some deals out there, take the money in and sits in an escrow account and grows mold for an indefinite period of time. And so there's a school of thought currently among the EB5 attorneys that just parking in an escrow account NCE is good enough to trigger a sustainment period. I fundamentally disagree, and other people do as well, that we don't think it really starts until the money actually goes to the project, and thus triggering the loan agreement. So if this notice of proposed rule changes go into effect on that, I think that clarifies the situation a lot and Yeah, and actually in favor of the investor to the detriment of the project. At the end of the day, we want this to be an investor-friendly program, and so some of those rule changes, which proposed rule changes, are in favor of investors.
Yeah, I agree to Brand's point of like when we discuss these, like there's something always happening or being proposed in EB5, right? And I think and Jeff giggles, but like part of it is that I think there's Brandon's response of like, look, it's all being proposed, it's all being debated, it's all being noticed and commented and everything else. It could be anywhere from 0 to 100% of its current form is absolutely correct. We live in a day and age where everyone wants answers, want clarity, they want hot takes or analysis instantly. But like I said before, most of law and most of the regulatory process is really boring, right? Really painful. It's not like a sports game where there's play-by-play or whatever else. So it takes time to unwind these things and let them play out and everything else. That being said, we can kind of see the proposed regulations and everything else. It gives us some insight into what the agency is considering or thinking and what sort of like I think which direction they're leaning, what they want to propose, and some I think abuses that they try to push back on. For bridge financing, I think a lot of us agree that there's really no practical universe uh, for EB5. There's no bridge financing. It forces investors to take on risks where you're entering a project that might not have everything in place, right? And might not even be under construction. It makes investors absorb a lot of that stuff, right? So practically speaking, it doesn't really work. That being said, the example they gave was they said something along the lines of, I believe, they are not comfortable with having bridge financing replaced if it's been over 10 years. Well, yeah, those are instances where they should easily strike it down. I don't think that's controversial, right? One or two, I think what it is the agency has an opportunity to
All
put
right.
some parameters or guidelines, right? As a starting point, like I think most of us think like 2 years or less is not crazy as a starting point. But if it's 7, 10 years out in the future, yeah, I understand why there's some trepidation there. So I think there's a way to kind of thread the needle. And I think that's sometimes the problem when you have people who on the agency side who write policy and regulations while being divorced from private industry, right? Especially when you look at this from in terms of real estate development and financing. It has to make sense, otherwise it's unworkable. Or
Yeah, and
yeah.
yeah, sorry. No, sorry. Go ahead.
All
Maybe
right.
losing my
So
thought, Jeff.
No, I was just going to say, sorry, I didn't mean to cut you off. I was just going to say for us, when we structured it, we weren't thinking of the regulations, right? Making them take the money by
Yeah.
September 30th. That's just a benefit with the new proposed regs. This makes us look a little better. To me, it was more about, seeing and a lot of these rural deals out there, which, there's people are rushing to get rural to market because there's some outsized demand for it. They're not ready, right? They're not shovel ready. They're a year out or more. For investors to see the hidden risk and the fact that, oh, it's a 5-year deal, but it really might be a 6 or 7 year deal, right? Not to say that they're not good deals, just be realistic about it. If your capital doesn't get deployed for a year or 2 years, the loan
Yeah.
closing doesn't happen, you're 7 years out. So when John and I talked about it, we're like, look, these are a quick build. They said we're only going to do deals or finance resorts that are shovel ready, construction's ready. Let's just make them take the money in a sweep, right? So they have to pay an extra month or two of interest. So what? Let's just give investors certainty, and I think that'll go a long way.
Yeah, Jeff, so you just inadvertently stepped on the rural versus high unemployment landmine, which I'm going to address because I know you run into some issues saying, "Oh my gosh, your project's high unemployment." And it might as well be like showing a cross to Dracula to prevent being bitten in the neck. And it dawned on me when we were in Shanghai last month or whatever it was, and the project people, to their credit, they were groups that have actually been in rural forever, and talking to the audience. And I was thinking to myself, and I think I said it during the panel, I was like, if we were doing this seminar here in Shanghai 8 to 10 years ago, and a group got up here and said, here's my wonderful rural project, you're going to be in a senior loan position, we'll be outside taking subscriptions afterwards, you know, half the people in the room would have got up and immediately left. Another half would have sat there and laughed at us. And so here we are, like everyone's talking about, yay, you're in senior position, yay, we're rural, aren't we awesome and everything. And this is purely, it's basically, the tail wagging the dog. Like probably 80 to 90% of these projects would have never been picked up for an initial call with a regional center pre-Reform and Integrity Act. And so, that's a concern. And then, you know, there's a simple, Fung probably sees this as well, which is, okay, yeah, rural has, you know, um, twice as many visas as high unemployment, and then you have the unreserved that sit to the side. Well, that's all, and so the assumption always is, well, I want to go rural because it's going to be faster. I'm going to get my green card faster. Well, that might be true as long as the ratio of rural to high unemployment applicants is 2 to 1 or less. However, the last statistics that came out showing, I think it was something like almost 3 to 1. Now, there's a reason why I'm a lawyer, and one of the reasons is because I'm not good at math. But I can look at that and say, wait a minute, that system is out of balance. And it's
Yeah.
not a question of if, but it's a question of when and how bad it will be. Rural is going to back up significantly harder long term than high unemployment. At a minimum, that purported time difference between getting through the system for rural versus high unemployment is going to be minimal to non-existent. And for those who doubt my analysis, that's perfectly fine. I tell you to, take a look at except for the last 3 or 4 months, take a look at the visa bulletin for EB2 and EB3, China and India, and what do you see? You see EB3 is faster than EB2. How can that be? EB2 is a superior category, more visas should be faster, et cetera, et cetera. Why is it slower? Slower for basic math, basic supply and demand imbalance. Everyone wants to get into EB2 because it's going to be faster, and in the process, made it slower. We're way past that tipping point for rural versus high unemployment. It's just a question of when, Phuong and I are hoping to go hit the golf course or whatever we do at 2 o'clock on a Friday afternoon, and the visa bulletin comes out from the Department of State, and surprise, rural's backlog, to whenever, then that's when it becomes real. And so,
You know, I we might be the only two attorneys who agree on this issue, right? I
and I'm
think
perfectly fine with that.
I the thing is this, your thoughts on rule, I mean, I agree. And this is something we've been saying for quite a while, right? So the thing is this, um, there's no question I hate more, although I understand why it's asked, then
Mhm.
should I do rural or high employment or urban, right? Um, and basically it's because why is that the first step of the analysis? It should be, is this project even a good project or good investment first? I always tell people, ignore the visa category. Who cares about the visa category? If it doesn't make sense as a project or investment, then it doesn't make sense at all. I understand, like, look, we understand the benefits of priority processing. There's more visas available and everything else. People rush into it because they perceive it to be faster, without any regard for whether the project's even safe, whether in the future you're going to have a whole graveyard of rural projects or any badly structured project that can't refi or pay off in the future, you know? There's a reason why 90 something percent of projects in the history of EB5 and real estate development for that matter are in urban areas. Rural is just much more difficult and specialized, right? And the other thing is, so I think so it has to make sense first of all. If it's rural or urban, it has to be a good project first. I think that's the first step. The second part though is I agree with Brandon. I think in year one of the RIA, there was a marked difference between rural projects being rural 526Es being approved and urban. But now we're in year four-ish, right? And there's instead of having 1,000 petitions, we have lots of thousands of petitions. It's
Mhm.
largely normalized, right?
Mhm.
On top of that, that backlog, that line is getting bigger and bigger and bigger for rural. So now more so than ever, if you're gonna pick a project for visa category, it makes less sense than ever, I think.
And
Yeah. So
just to
Jeff,
finish,
and you're
yeah.
sorry,
So I was
John, let
just
me
going to
come
say,
in.
just to
Yeah.
finish that is, and not to paint with a broad brush, but the quality of the rural projects in the beginning, they were, I mean, fantastic, right? Because they were the first ones in
Yeah.
those areas, right? Well capitalized, blah, blah, blah. Now it's a little bit more, chasing the designation, right? And the quality we've seen. We haven't been able to find a rural project. It would be a lot easier for us, quite honestly, if we did. But our CIO, Greg, he says no to everything rural so far because we haven't found good projects. Anyway, sorry, Brandon.
So, no, Jeff, let me tee this up for you so you can start far down the fairway as you want. In your prior positions with the various prominent regional centers that you mentioned, pre-RIA, how many rural projects did your previous group or groups take on?
Yeah, in about the $2 billion worth of deals. Pre-RIA was probably like $1 billion and change. I think it's somewhere around zero, give or take.
Yeah, plus or minus, yeah.
Oh,
And that was at the 500,000 threshold, not the
Right,
800,000,
right,
right? So it's even more investors that, yeah.
right. In the meantime, sold out a $250 million New York City real estate project in 6 months, right? So
All right. So I
All right,
wanted
so
to,
hey, we're officially off topic.
yeah,
that's all right. That's how you
get
know you're
back to
having a good
topic. And
webinar.
that's what happens when you tell me and Brandon just start talking and talk as much as
No,
possible.
no, listen,
And this is sober, by the
Jeff
way.
and I talked about it. We're like, we're not going to get into the whole rule. Listen, we could have a 6 hour webinar and I
Yeah.
could show you the model that I built that basically tells everybody it doesn't matter. Everyone's going to revert to the unreserved category and it's all going to be based on your priority date, right? That's my
Yeah.
view and it's
Yeah.
shared by others in the market. But
Yeah.
we'll swing it back in, Marie.
right. So let's talk about the repayment mechanism for your project real quick before we do touch briefly again on the regulatory, so we have time to do the Q&A at the end.
Yeah, so I'll be quick with that. So again, how does this project get repaid? I think we talked a lot about, what the plan is for these guys, right? They're building all these resorts. They're going to stop building within the next 12 months. They're going to let them all mature, and they have a plan to exit, hopefully, sell to private equity in 2030. That timing is aligned with the franchisor, which they own a big percentage of. So the intention, and again, these guys are smart guys that know how to get the best exit, is to align themselves and sell at the same time with the franchisor. So that's the primary piece of the exit, or how it's going to work. Interestingly enough, there's multiple other paths, right? As I mentioned, right now it's difficult and cumbersome for them to get, senior debt, and almost impossible for them to get enterprise level debt from a large bank institution. Once they cross that 10 million in EBITDA, which comes in 2029, that's going to open that door for them. And I think it's going to be a question for them of, okay, when can we go out and get this enterprise level financing, pay off the existing senior debt and the preferreds? And is that too close to when we're planning on paying, like selling ourselves? So that's another option. And then, really the last option is this business, by the time, like I said, 2029, they'll be cash flowing, 12, 13 million. The next year, 17 million, and then it goes up, a little bit from there because at that point, all of the resorts are mature. So in theory, they actually cash flowing enough to potentially pay us down through operating cash flows, which is, surely something you don't ordinarily see in the market.
Yeah, I mean, you're not going to see a hotel in year 5 pay you back from revenues, right? So completely unique.
All right, I know you guys, we've already touched a little bit on the regulatory aspect. We touched on the bridge loan and the sustainment period. So let's just do this real quick just to clarify. Brandon, what are your thoughts on the update regarding the bridge loan for the
Yeah,
proposed?
so yeah, I mean, we'll ultimately see what comes out. I mean, as Phuong mentioned, USCIS is kind of, high level position that bridge financing doesn't create, or the repayment using EB-5 money to repay bridge loans doesn't create jobs in and of itself because it was actually the initial money that went in. Like I agree with that, but I think that's probably ultimately going to be the biggest point of contention in the final rule. And well, yeah, but I mean, one good thing about the EB5 industry is we've been through. I came into this industry about 2 months after the four precedent decisions came out. Matter of Hose, Sofici, Izumi, and I forget the other one, maybe Fong remembers, which basically killed EB5 for about 10 years. And we kind of survived. EB5 industry is resilient. We always kind of figure out something and move forward. And I expect the same thing to happen here. I think the overall health of the EB5 industry today is a lot stronger than it was 10 years ago. And that's a good thing for everyone.
All right. Phuong, what about the sustainment period and the proposed changes there?
Yeah, I mean, it'll be an interesting thing because part of it is always, again, there's always going to be this tension, right? Between even if you close on an EB5 loan and you make it all available to a project, the project might not necessarily be able to draw upon it yet.
Mm-hmm.
So how is that fair to an investor if for example, their lock-in or everything else is now up in the air? I think for the most part, I'm of the camp, for example, that considers that once an EB5 loan closes and the money is made fully available to draw from the JCE, then the same period begins. You can spend on whatever you want. So if the project at that point is that they can take it, they can draw upon it, they can use it for whatever else. Otherwise, you wait for actual deployment, God knows when that's going to happen. And practically speaking, even if there are some investors that have asked, can we just release all our money to the JC right away on day one? I'm sure every single project and developer out there would love to just have a few $100 million just sitting in their account. But there's construction managers and fund administration for a reason, right? Want to make sure money is spent properly. So there has to be a happy medium between those two things. So,
Mhm.
uh, Jeff and John, I know what you guys did here with 3 year lock-in. It provides some degree of predictability there, but I think bridge financing, sustainment, a number of other things. I expect that to be a very vigorous back and forth notice and comment period.
All right. What about the self-directed IRAs? What are
So
your thoughts on that?
the self-directed IRA, from a USCS perspective, it's not a USCS issue. The issue is whether It's it's if you're using it to invest in an EB5 private placement offering, does this fall under does this theoretically, is it prohibited self-dealing, right? Is it something that is considered prohibited under the IRS tax code? And the honest answer to that is it's an issue of first impression. Um, it's the agency has never considered it. EB5 is not specifically enumerated as a prohibited transaction. Very few things are, right? But it's like one of those things where I think if you needed either the only real clarity I think we'll have on the IRS side is if someone reaches out to them and requests something very similar to a no action letter from the SEC, right? Um, Otherwise, I think this will be up in the air for a while until I think we have some tax guidance here. So there's
All right.
there's arguments on both sides.
All right. Thank you, guys. So
Yeah.
we have a couple of minutes here for Q&A. So hand it over to you, Jeff.
Yeah. Well, the first question is, there's a few good questions. Why is this preferred equity and not debt? And that's something we hear about a lot about. John, if you want
Yeah,
to start.
yeah. So, I mean, we do get that question a lot. And I can tell you, after spending 25 years on corporate desks on Wall Street, the right question to ask is how much equity sits below you, right? So it's not about the whether it's preferred equity or debt. It's about what the capital structure looks like, which is why we spend so much time. We showed you the capital structure slide, right? Stressing the capital structure. I'd much rather have a deal that's preferred equity with 75% of equity below me than a deal that's debt with 30% of equity below me. And quite frankly, initially when we started this deal, it was proposed to be debt, right? And we didn't want it as debt really for two reasons. Number one, and not to get into the weeds, but for tax reasons, it was not tax efficient for the fund and ultimately for the investors. And then secondly, the only thing that really debt has, in particular mezzanine debt, which is what we would have been here, mezzanine debt has versus preferred equity, is they have the right to force a liquidation if there's a default, right? And the reality is we respect this management team. They know what they're doing. That's a right that we would never use, right? If we ever triggered a default because they didn't pay interest or something, we would never force a liquidation anyway, because that's not good for the sponsor and that's not good for our investors. So, what did we get in return for that? Right? We get the same things that debt has, right? We have, if there's a breach or if there's a default, everything locks up. You can't distribute anything to equity. We have the same LTV type covenants. We have major decision consents. We have board advisor or observer rights. But more importantly, we were able to get some enhanced rights with the preferred equity because there's some, rules around what you can do when you have debt. Like, for example, if there's a default, right, you're only allowed to sort of, what's acceptable to increase and have that default interest, right? It usually falls in that 2 to 4% category. If this thing misses a payment, our interest or our dividend jumps up to 20%, right? So it creates a massive disincentive for them to mess with us. And then also what we're able to build in is the longer this thing's outstanding, and this really starts after September 30th, 2029, which is 3 years, the amount they have to pay us back escalates, right? So it goes up every quarter it's outstanding, it goes up. Again, an incentive to repay us back faster. So the punchline is we didn't want to force a sale. We just wanted to rely on, smart economic type, remedies that can protect us. And that's why we chose preferred equity. Quite frankly, it's a better structure for what we're doing than debt would have been.
So like real preferred equity with escalators and punishments and everything else, right? So okay.
Yeah, exactly. And we always tell them, it's like the cheapest capital they'll ever have is the capital they pay back on time. Because the longer they wait, the more expensive it gets. And I'd rather have that right versus, Jeff and I are not going to go out and try to liquidate and sell their business. We'll get our face ripped off and we'll end up losing money for our investors.
I think that's an important point too, because there's so much talk about senior loans, preferred loans. And the thing is, you can have the best collateral in the world, but the reality is nobody ever wants to foreclose, right?
Mhm.
If you foreclose, you're basically screwing yourself too. Like that's an absolute worst case scenario. If you foreclose and it's people see it and everything else, you're going to get lowballed and it's just a nightmare. And all it really guarantees is your repayment will probably be further delayed, which is why when you can actually pinpoint actual cash flow coming in that will take you out and everything else, cash flow is collateral. It's always preferable for that reason. It's not rare in private credit. It's just rare in the world of EB5.
Yeah.
All right. Well, thank you, everyone. Thank you for joining this webinar. Unfortunately, we're at time. I know Jeff, wanted to put up some final slide.
Oh, yeah. Just,
and
I'm sorry, share our contact
to
information.
show everyone how to get in contact with everyone. But yes, thank you very much. This webinar will also be on our website afterwards if you wanted to, listen back on some of the issues. So thanks, everyone. And thank you for helping us explore the corporate credit aspect of EB5. Thank you, guys.
Yeah. Thanks, Marie, for hosting. Thanks, Phuong and Brandon. Really appreciate it.
Yeah, thanks, everybody.
Thanks, everybody. Thank Marie, too. Thank you for dealing with us. So.
It wasn't too bad.
Yeah, you did great.